know if anyone heard the last couple of minutes of our panelist conversation, but if you missed it, you missed out on some very intricate details of Icelandic deadlifting, which I'm sure Jeff Busgang will happily field questions on at the end of the session. So thank you all for clicking in to our Venture Crush FG session today. This is Ed Zimmerman, and I chair the tech group at Lowenstein Sandler, and I'd love to make sure that the panelists have a minute or so each to just introduce themselves and their backgrounds. In the chat, which we plan to use, we've loaded I guess either a link to a pamphlet or a little bit of a booklet that gives some backgrounds, and you should already have their respective backgrounds. We had originally planned to talk about product market fit, but we're going to preempt that for discussion of what's going on in fundraising and or the lack thereof, as well as details on Icelandic deadlifting at home. So Jeff, do you want to be the first in the Hollywood squares here to give your brief background, and then we'll move to Haley and Jody and Monique and Kirby?
Sure, with pleasure. Thanks. Great to see everybody virtually. It's a crazy time, and it's always fun to have these platforms to be able to engage and have some dialogue across firms and across the community. So I'm Jeff Busgang. I'm a venture capitalist, co-founded a called Flybridge Capital, early stage firm focused on tech, based out of 2 offices in New York and Boston. So we mainly invest on the East Coast and outside of the Valley. Been doing that for about 18 years. And for the last 10 years, I've also been a professor at Harvard Business School on the side teaching entrepreneurship.
Great. Haley?
Hello, everyone. My name is Haley. I'm a partner at First Round Capital. Before joining First Round, I was a founder. I co-founded a company called Birchbox, and I'm an alum of what was called First Growth at the time. And I'm also a lucky recipient of some of Jeff's professoring. He was there at the very early days of my founder journey.
Cool. Jody, you want to go next? I'm trying to do this in physical location order on my screen.
Hi, I'm Jody Jayek. I am a co-founder and managing partner of Aligned Partners, where we focus on early stage enterprise Series A investments. Unusually, we focus on founders that want to raise as little money as they can get away with, not as much money as they can get away with. So all our founders are highly capital efficient. I've been a venture capitalist for 21 years now, which makes me feel ancient. Before that, I was, before going to the dark side, as my family likes to say, I was on the founding team of 3 startups. Glad to be here. Thanks for having me, Ed.
Thanks for being here. Monique?
I'm Monique Woodard. I'm an early stage investor based in San Francisco. I invest in pre-seed and seed stage companies. I've been a scout investor for Lightspeed and also at 500 Startups, an investor at 500 Startups, and now I'm starting a new fund called Cake Ventures to also do seed stage investing across areas of demographic change.
What does it mean? What does it mean to be a scout?
It means that I write, six-figure checks into any number of companies that I decide around any thesis that I particularly want. And as long as it's not too crazy, Jeremy over at Lightspeed will say yes.
So scout means just lacking in discipline, but not lacking in early stage money?
I basically invest around my investing thesis, which is all around demographic change. So, the 10,000 baby boomers turning 65 every day, companies that can get to billion-dollar outcomes based on the economic activity of women, or, this shift to majority minority in the United States. So those are some focuses.
All right, so we're definitely going to talk about demographic changes.
Yeah.
Kirby? You're on mute, Kirby. Remain in stealth mode. Can you hear us? There we go.
Can you hear me now? All right. Kirby Harris, co-founder and managing partner at Base Ventures. I've been a venture capitalist for 10 years. Before that, I did private equity. I'm a Kaufman Fellow. Base Ventures is a seed and pre-seed venture fund, and we are on our third fund. And we're actively investing through this COVID.
Let's start there, because you said you're actively investing through this period. What does that mean? Are you writing first-time checks into companies that you're just meeting? Are you looking at companies and trying to, like, what is it?
Yeah, so we're continuously evaluating companies. We've been in lockdown for 6 weeks, so but yeah, we're still evaluating and looking to write checks. So we have a couple of opportunities in the pipeline, and we're in process.
Okay, so one of the things that I know has been hotly discussed and that we were discussing just before folks logged in here is, to what extent are people writing checks since we've been in lockdown, and how different does that look? And I know we're going to spend a little bit of time on that. I also want to make sure that people know that they should definitely use the chat or the Q&A to ask questions or suggest topics that they want to hear about. But I'd love to hear about checks that people have written since the start of the quarantine period, particularly if they are first-time checks into companies in which you were not an investor before the quarantine period began.
I can speak to that. So, I mean, first, people should realize that the time of a venture capitalist is always split between portfolio activities and new investment activities, in addition to firm management and fundraising. And for all of us, we're quite consumed with the portfolios because all of our portfolio companies have been having emergency board meetings and resetting their 2020 plans over the course of March and April. So there's a natural tendency for firms to look inward to the portfolio from a time standpoint. And then there's the issue of capital allocation, where our portfolio companies now need probably more reserves than they previously had needed or we would have forecasted. And so there's a natural time and capital crunch that all venture firms are facing. So even though we say we're open for business, and we are, and I'm sure everybody on this call is open for business, and I'll tell you about a couple of new deals we did, there's just a natural gravitational force that the portfolio is providing us from a time and capital standpoint. And then on the new deal front, for us, we've made 3 new investments in the last 30 days. 2 of them were with known founders to us, people that we knew very well, one a repeat founder, one a former colleague, and the third was a deal that was already in motion. So I can't say that we've yet invested in somebody that we did not know pre-COVID, pre-lockdown, pre-being able to meet them face-to-face. It's not that we're not open to that, but it just hasn't happened yet. And I think the bar is quite high to meet someone only over phone or Zoom and invest in them cold, unless you can get some really good reference data on them.
Yeah, so we've been really active, and we actually were making investments without meeting founders face to face in the past 12 months because the seed market was moving so quickly. So it's actually not a new threshold for us to cross to be comfortable doing that. That said, I think, is it just business as usual? No, I think we're figuring out in real time what sort of uncertainty we're willing to take in terms of market conditions, where prices should be set, and And also, Jeff mentioned the friction of having to spend a lot of time and effort on your existing portfolio. I will be honest, at least for me personally, I've had to figure out how to work from home with 2 kids under 3. And that's impacted my ability to evaluate and think about new investments. So what's going on in investors' personal lives are also playing a new commitment. So
Haley, you're cutting out a little bit. I don't know if you have headphones, but just
I'll try something different. Sorry.
okay. So and if you want, we'll come back to you.
Is this better?
That is
closer
much
to the
better.
microphone. All right,
Yeah,
thank you.
awesome. So are you? Can we just talk for a minute about the fact that you are trying to figure out how to do your day job with these 2 little kids around? How do we think about that if we're a founder trying to get on your radar and trying to get access to you? You said that's changing the way you're approaching things.
Yeah, I think a little bit of patience on the part of founders in terms of what my turnaround times might be. I do my best to have like a very clear SLA, but I find myself breaking that sometimes. And I think it's just best practices for any fundraise that founders should be really clear about their own timelines. They should do their best to create momentum in their fundraise and therefore get investors to hit their deadlines. We actually had an emergency partner meeting on Sunday to take 2 founder pitches because we felt that we had to get those founders an answer before Monday. So if founders can create that sort of train is leaving the station sort of timeline, then that's the thing that will get me to log back on my computer at 9 p.m. after the kids are in bed and make sure that's the deal that I move forward evaluating.
And how do others feel about creating that momentum and that forcing function? Because it can also feel insensitive, particularly because right now is a time when we really don't know what's going on in someone else's lives, and you can get annoyed at someone's lack of empathy, whether they're an elected and impeached political figure or otherwise. We're looking for folks to have some empathy, and I think empathy is a bigger part of leadership. I know a number of us want to discuss leadership on this, but how are you finding people thread that needle of creating immediacy without being annoying?
Yeah, I think being able to create some sort of FOMO in a fundraising process is always good. But I always tell founders, make sure the FOMO is real. If you say, this train is leaving the station and this deal is closing in 2 weeks, and 2 weeks rolls around and it's not closed, I'm kind of, I'm less apt to think that any deadline you set is a real deadline. And for me, I tend to like to get to know founders for a while because I do invest really early, and at the very earliest stages, it's totally about team. And so, meeting going from 0 to writing a check, in a week or 2 isn't necessarily something that I'm probably going to do, even outside of COVID, even outside of, not being able to meet in person. So you have to understand how each individual investor works and what their particular trigger points are. I think when you're talking about earlier stage investing, I think there is the opportunity to get smaller size checks from investors who invest really early without having met them face to face. I think that does exist. I think as you go into later stages, that gets a little bit trickier and much more difficult to pull off. I'm advising, a firm at later stage on their early stage strategy. And, I know for a fact that they're not doing very much later because the time from investment to liquidity event is so short. So I, for a lot of those very late stage firms, they are waiting until COVID is over or controlled or shelter in place is done. And I think that's just really
seeing them. We're competing with those firms more often than we were a quarter ago. So some of the most competitive seed deals that we're in, it's actually competing with multi-stage firms for those.
And I think we're going to start to see that a lot more often because they're not going to do those later stage deals where the time to market or time to IPO or exit is, 18 to 24 months or so. They're going to start reaching back into an earlier stage bucket.
I think founders have three things that they're dealing with in the fundraising market, two of which we've kind of unpacked a little bit. One is the competing needs of investors and managing their portfolio. And Jeff is right. I mean, that's been a very significant load. We've got to take care of our portfolio first. We're already invested there. The second is the challenge of getting to know companies and founders well enough to create that kind of long-term relationship. And I always joke with founders, I mean, these are not just marriages. Marriages you can get divorced from. You can't divorce your investors. This is really long-term. So there's that challenge as well. But there's a third challenge that, that's real. And that's that assets don't have prices right now. We just don't know what valuations are. And, whatever we speculate about publicly is going to be wrong. Please don't ask me what the hell's going on in the public markets because I really don't understand. I'm socially distanced from the public market right now. But we know that we're wrong about valuations wherever we come out on them. That may be less of an issue at the very earliest stages where valuations come in a fairly narrow range. I play at Series A. I don't want to be wrong. I don't want to be wrong because of my investors, and I don't want to be wrong because when we price something wrong for our portfolio companies, our highly capital efficient portfolio companies who are trying to raise, again, as little as they can get away with, not as much as they can get away with, that then comes back to haunt you later in a at leisure, in a down round or some other kind of crushing event. So all that speaks to long fundraising cycles. And what I'm observing, at least out in the field, is that companies that are fundraising are falling into two camps. One is can't lose, going to raise no matter what. Doesn't matter what the market conditions are, they're going to raise. And that's a great place to be in. You're probably not asking questions about fundraising if you're in that camp. There's companies that can't put off the fundraising. They need the money now. And it's really hard going right now. Everybody else is postponing. Everybody in our portfolio is postponing. So, on the one hand, as a founder, rising above kind of the mush of companies that must raise money now, there's a lot of flotsam in there. If you're a great company, you really will stand head and shoulders above the rest there. But it's noisy and it's rough and it's dangerous to make valuation decisions right now. If you can postpone, you should postpone 100%.
It's funny. Can I just comment on linking what Jody and Monique said? It's so interesting. So Jody is totally right that valuations are a big question mark and we're all trying to figure out what those valuations are. But Monique said something really interesting that I've seen a twist on the behavior she's describing. So the later stage firms, they may not be as active in pursuing new deals, but what we've seen is the later stage firms coming to our earlier stage portfolio companies, the ones that maybe they didn't get into or the ones that they've been tracking for a while, and they're pursuing them quite aggressively at lower prices. So they're coming in proactively and saying, boy, tough time to fundraise. We love you. We've gotten to know you. Why don't we invest in you? But here's a price that's maybe 20% below what it would have been 3 months ago, but we'd love to invest with you at that price. And so a lot of the Series A, Series B, and Series C companies have this dilemma, which gets to your which is a really interesting question that Jody sort of planted as a seed, which is, when does the market change? And as a founder, do you bet on the market getting better within a 6 to 9 month window, in which case you turn down those opportunities and you, to Jody's comment, you 100% don't fundraise now, why would you? Or could the market get worse? Like, we don't know. This market may be as good as it's going to get for the next 12 to 18 months, because people are still in an adjustment phase and the market may get a lot worse. We have no idea. And so for a founder, it's a really tough set of questions.
And just picking up on that, because that also goes to the issue of what instrument do you use to clip some of that uncertainty. And we've been in a market for the last 10 or maybe a little bit more years where the instruments have largely been designed for an up market. And we are seeing, and people are going to learn the hard way, that some of the instruments that were lightweight and easy and that worked in an up market really do not work in a down market. And I'm speaking specifically of safes and convertible notes with a valuation cap. The fact that everyone talks about the valuation cap is, I think, indicative of most of the emphasis being on the extent to which investors need protection from escape velocity pricing on those companies. People don't talk about the absence of a floor and the fact that if, as Jody reflected, the price goes down, the safe holder or the convertible note holder is going to be getting a much, much better deal and a much, much bigger chunk of the company than was planned for, or than may be appropriate from an incentive perspective for the founding team, and it may be off-putting to new investors. And one of the things that we saw in 2001, 2002, and 2003, there were a series of investments that created structural impediments where companies just had overweighting of equity for existing investors and underweighting in equity for management. That has not been a problem for the most part in San Francisco. We see that sometimes in deals in Israel where it's a problem because the investors came in at a really low valuation. And so just making sure that people are being thoughtful about whether one size fits all, or whether in the context of a new market where the eventual price and terms may be worse than today's price and terms, we're prepared for that. And so I wonder whether you can speak to how thoughtful your funds are being and how thoughtful others are being in market about that kind of structural planning in these deals and in these companies. I know that we have a lot of questions both in the chat to everyone and also kind of privately to me about what's changing in terms. So what are your thoughts on how people are preparing these deals? Are you seeing any changes in the way people are approaching them?
I would love to go further to people who are doing deals like Haley. I would tell you that our assumption is that we are in a deflationary market.
Yeah, I can talk about our some of our current portfolio companies that are in the A and B and C rounds where they've seen. We've had one company that was had an equity term sheet prior to COVID, and that equity term sheet turned into a convertible note term sheet at a 40% discount to what the equity round was priced at. And we've had companies that were raising 10, 12, $20 million turned into $5, $6, $8 million rounds. So I think in the later stage, it's been pretty. They've been much quicker to adjust than seed rounds. Seed rounds, we're still seeing seed round term sheets at similar valuations to what, pre-COVID. And that's been steady, from beginning through today. I think seed investors or seed founders just have more runway and expect to raise longer and are, if you're a seed investor, you're investing in the come more, or in the prospects of the business more than actual numbers, where later stage founders or later stage venture is about you're investing in a set of numbers and a set of assumptions based on numbers. So it's a much more technical exercise. It's a much more technical exercise than what it is at a seed round. So I have some thoughts around what that looks like, but as it is right now, that's been the state of play, as what we've been seeing over the last 6 weeks, 2 months.
I'll just add, I think it's too early to see a lot of down rounds or recaps. To Jody's point, if you don't have to raise, you're sort of waiting at this point. But the most frequent structure we're seeing for later stage companies in our portfolio who do want to extend runway is sort of the top up, where they're not being picky about valuation. They're just opening up at the last round's post, making it a priced round, and just scooping in a little bit more cash at the same time as they're changing their operating plan to make sure that they could extend their runway, ideally to not have to fundraise their next true round until the markets have sort of figured themselves out.
We are seeing a lot of that, the top up of the last round. And again, given the deflationary assumption, founders, if that's available to you, that's a generous proposition. Like, don't be afraid of that. That's pretty great right now.
Yeah. And then, Ed, you asked about structure. So we saw in 2000, 2001, a lot of priced rounds. In 2008, 2009, a lot of priced rounds. And then the convertible notes kicked in, and then the safe notes with fewer and fewer terms and attributes. And I feel like there is a shift perhaps to going back to the priced round for the seed stage deal, even for the $1 million, $1.5 million seed stage deal, which on pricing, at least what we're seeing, the company that might have raised at an 8 or 10 or even 12 post at the seed stage is back down to the 5, 6, 7, 8 range, which was where things were prior to the last couple of years. On the West Coast, I know it's a bit higher, maybe more like 15 to 20 for some of the companies that are perceived to be hot. I don't have as much data on the West Coast, but I hear anecdotally that's also come down to more like 10 or 12. And then the one other thing I've seen is a floor in addition to a cap on the safe note. I've only seen that a few times, but that seems to be a new tool that entrepreneurs are using to try to bound the range of valuation so they don't get caught in the scenario you're describing, where maybe you raise in a note with a 20 cap and you think you've raised at a valuation of 20, but then 6 months from now you're only able to raise at a 5 or 6 or 7, and suddenly you have a massively dilutive financing ahead of you. So people are saying, well, look, I'll give you the 20 cap but a 10 floor, or a 30 cap and a 20 floor, something like that.
Yeah, working within the confines of the convertible note or the safe, we're going to continue to see a lot of that at the earliest stages, simply just because of pure deal volume. I think until deal volume sort of falls off a cliff, we sort of have to figure out how to best do this on a convertible note. But if over the next 12 months deal volume reduces significantly, then I think we will see a return to rounds at the very earliest stages. But until then, I don't anticipate that yet.
In reference to deal volume, we ran the numbers last week of the inbound to first rounds and how April 2020 compared to April 2019, and it got cut in half in terms of inbounds. And this could be a temporary, like maybe this was the craziest month, everyone took a breath, and May and June will be back on track. but it was really interesting to see how dramatically it had shifted.
And so your deal flow of new opportunities for first check from first round has been cut in half.
Yep. So whether it's referrals, people reaching out organically, it did fall off a cliff in April compared to last.
I'm seeing the same thing, by the way, Ed. That's why I was referring to like the bifurcation of what's available on the market. It's the sure things and the we can't put it off.
Yeah, and
because we are actively investing, we're trying to do what we can to get the volume back up. So actively reaching out to co-investors, pre-seed investors, letting them know maybe your best founders are waiting right now because they can. But we're having emergency partner meetings on Sunday. We're looking at so much. We're like excited to invest right now.
So someone asked in the chat, you had said something about an emergency committee meeting on a Sunday.
Yep.
Did you guys invest in that one? They wanted to know what the follow-up was.
One of them. We are issuing a term sheet. Hopefully it will be signed.
Okay. And
but it's usually a 50% approval rate if something comes to a partner meeting.
And so I want to focus on a couple of things that we heard. One is, sure, the great companies are getting funded. The problem is that you actually have no idea which the great companies are. And if you did, everyone would want them or everyone would pass. So greatness becomes something that you determine in the rearview mirror, and you don't know which great opportunities got stomped out. And right now is a time for people to prove themselves in different ways, in ways that we haven't had to before. And there are different skill sets that will really be valued in this time period that are maybe less valuable in other time periods, and vice versa. And so when you think about that and how you determine whether you're a great company at B round or C round, it's different because there's so much data at that point. At seed round or even A round, it's much harder to say this is a great company, this is not a great company. You can say this company has tremendous promise, this company has stuff to work out, but one of them could be worth 5 billion in 5 years and the other could be worth 0, and it's not very clear which is which, and they're probably both in between those poles. So how are you using those tools, and how are you thinking about filters for those kinds of things in this market? And I really want to come back to also the cutting deal flow in half, because that's a fascinating concept. So talk about the filters that you're using, and then let's come back to the issue of what do VCs do when the deal flow is cut.
I'll just name a few things that are working for us in terms of getting us excited about making investments right now. Really good product demos are great over Zoom. So even if it's mocks, just really being able to bring an investor through what the product looks like or will look like. Doing a lot more customer diligence maybe than we would have previously, whether it's existing customers or connecting founders with prospective customers to get their input. And all of those things are helping us get more resolution on the investment decision outside of being able to just have the chemistry of a face-to-face meeting.
So I'll throw out another kind of metaphor. So my daughter, as Ed knows, used to be a competitive platform diver. And in diving, there's this notion of degree of difficulty. And I think if we all look back in the last few years, the degree of difficulty was a heck of a lot lower. People were doing single flips, double flips, as compared to what the entrepreneurs have to go through today in the midst of a pandemic to execute on their plan. It's a much higher degree of difficulty. So for us, examining how they're executing in the context of this environment is really interesting, whether it's how much progress are they making on the product, whether it's how the customers are reacting in the midst of a pandemic. It's a really great way of discerning, is the product a must-have or a nice-to-have? How their leadership skills are being implemented as a remote founder and leader of even a small team of 5 or 10, observing how they're handling that. Recruiting is a heck of a lot harder right now, much higher degree of difficulty. And so who's able to recruit is more distinguishing. So we're sort of watching and seeing how founders are executing. And I think in many ways being able to observe some of those attributes of recruiting skills, leadership skills, product skills, quality of the value prop in a way that we maybe would have had more of a cloudy view 6 months ago or 9 months ago.
Is recruiting something that's core right now? I mean, it's hard to be ramping spend in this environment. And I don't know, Kirby, how you're feeling about the base portfolio and what's happening there, but how much emphasis are people putting on recruiting? Because I know that, just having a job is a retention tool at this point for a lot of places. Kirby, do you have a view you want to share on that?
I mean, again, around our later stage companies, like I said, we've had a couple that kind of pause recruiting, even though they're really set up for this kind of environment. And they got through a couple weeks of it, and they just had so much demand, and they had to recruit. And people are able to, like you said, our best founders are able to add people. So one company just grew their base from 70 employees to 105 over the last month. So,
and were those added headcount? Were those people mostly remote? Were they mostly technical?
and no, they were not. Yes, they're remote. And no, most of that headcount was not remote. Most of that headcount is not technical. It's more customer service. Okay. Customer service. Yeah. So, but we've had a few founders that needed some technical recruiting, and we've been able to do it pretty easy, but it's been small. I mean, it's only been one or two people, one or two, three key hires is on the technical side is we've been seeing.
And are we seeing convergence? I mean, there's I'm struck by a comment Haley made maybe 15 minutes ago, where you talked about competing against these multi-strategy firms. And a piece of feedback that I've given founders in the past, they've given me a list and said, hey, do you know these VCs that I think might be interesting targets for my company? And just as an example, I have on occasion emailed them back saying, there is no company for which and I'll use a live example, for which Insight Partners and First Round Capital are both targets, right? There shouldn't be any overlap between a growth equity investor and a seed stage investor, but because they are dipping down, and I'm speaking of any fund in particular, but the later stage folks are dipping down into earlier stage bets, and because your deal flow enables you to say, hey, there was a company that talked to us 6 months ago. We thought they were overpriced or overvalued. Maybe they did a round and maybe we can reopen it on those terms and get in. Are we actually seeing convergence where not only will funds invest a little bit out of scope from a stage perspective, but where the band of what gets investment is really like seed plus to B, as opposed to companies, across a broader spectrum of stages?
We're already seeing more overlap in the later stage dipping down. We also think that there might be opportunities for companies with significant traction that might have been raising small A to be considering a second seed. So there's overlap there, but does the band shorten on the smaller side in terms of pre-seed or early seed? I don't think so. I think for great founders with big ideas in the right markets, I think there'll still be pre-product, pre-revenue seed investments happening.
And what are the right, and this is for all of you, we've got a lot of questions in the chat and privately. What are the right markets? What are the verticals that are particularly interesting right now?
They haven't changed dramatically for me. I'm, as an individual investor, I still invest in a lot of consumer companies. I'm not doing as much, I would say, direct to consumer. I'm looking at more marketplaces. I'm looking at, and in areas where I traditionally haven't invested, I'm occasionally taking a few meetings there to try to sort of ramp up my thoughts around online learning and ed tech, right? So I think you'll see some VCs dipping into areas where they think our current climate is going to accelerate growth in that sector. But for me, it hasn't changed dramatically. I still think the aging space is ripe for innovation. I still look at companies that speak to the needs of women. Those haven't changed, but within those categories, the specific sectors have switched off and on a little bit. So looking more at online learning, a little bit less on the consumer side. It has excellent around direct to consumer for right now, just because I think while e-commerce will grow, consumer consumption will contract as we move into a real downturn.
Other people want to share, and are other people taking a dim view of online learning? I know that the view in my house with the two college students who are now resident here again, they are less enthused about online learning than I think people expected. You've made investments in that space, right?
Yeah, we have 3 companies that are doing quite well in that space: Code Academy, Open English, and Osmosis, which is focused on healthcare professionals, and all of them have seen substantial jumps in activity. So that market does seem to be doing pretty well. Online grocery seems to be doing well for obvious reasons. We have a company, Imperfect Foods, in that space that's seen a substantial increase in volume for obvious reasons. We've been more enterprise and infrastructure focused, and so the opposite of what Monique said, we're very sensitive to what corporate budgets look like as opposed to consumer budgets. And right now, corporate budgets are looking pretty good at the large scale enterprise level. Liquidity is pretty good, and they feel like many of them, their businesses are still pretty solid. How that plays out over the longer term is a big question mark. But by and large, if you're thinking about a history of shift to the cloud, big data, cybersecurity, machine learning, all of those trends still apply beautifully, we think. And then the wrinkle that over the last year or so we've identified as an investment theme is what we call community, and community as a competitive weapon. Companies, whether it's an enterprise company like MongoDB or even more of a consumer company like Chief, or more professional oriented community builder like Chief, we're seeing companies employ community as a competitive advantage. And it feels to me like a really interesting theme, even in the post-COVID era where people are so hungry for community. That's probably going to be less of a in real life community orientation, more virtual community orientation, but that seems to be a pretty rich theme area still.
And do you think that something like virtualization is that seems like a really sustainable thesis that's going to go for years and years and years, whereas online education, people maybe can't wait to get back to doing things less virtually, and that might be a temporary blip, which over the next 2 years could be a great bet, but over the next 5 years, we've seen how that has played out for other companies that raised a lot of money in that space and then watched exit values compress a little bit. Does it go back?
Yeah, I think all of us are wondering, are these temporary shifts or permanent shifts, and how long do these shifts occur? In some cases, it's an acceleration of a shift. Wayfair is an amazing story. The Wayfair stock dropped to $25 a share in mid-March as people got worried about general economic environment and online shopping. And then people realized that Wayfair was a winner in the shift to e-commerce. And as all retailers were shutting down, Wayfair is now just on fire, and the stock is at 170. So in 30 days, the stock has gone up 7 times, which is probably a better return than any of us will ever see in our venture portfolios on an IRR basis. 1 month, 7x. So I think there's these interesting pockets that are permanent shifts that we're all looking for. And then the final observation I'd make is that we're all on this panel relatively early stage investors. So we're looking at 8-year trends and 10-year trends, not 2-year trends. And so anything that we conclude is a temporary blip or something that's just relevant in the COVID world, that's not going to attract our attention. It needs to be something that's maybe accelerated by the COVID world, but more of a long-term secular trend that's has decades of potential ahead of it.
So along those lines, there are a couple of questions that I'm going to try to bundle together, and one of them is from Ashley: how are you thinking about early companies in categories most closed right now? And another set of questions I'll distill into what about companies that depend on bringing people together in person in some way? What guidance do you have for those companies, not as someone vetting them for investment, but as someone sitting in the boardroom and helping out?
Yeah, my advice to those sorts of companies is stay alive. Right? Because eventually we do get to a point where we are gathering in groups again. And so is that company still relevant when we are? And the only way to figure that out is for that company to stay alive long enough for us to get past COVID. So I'm seeing a fair amount of companies that are building something specifically for COVID. And I'm a little bit less interested in those sorts of companies versus a company, as Jeff said, that is noticing something that was already happening and it's accelerated because of COVID, but it can completely exist without COVID being as prevalent. So I think I don't think people will be making new investments into those companies that are around ticketing or anything that revolves around a physical space. I think that those investments can eventually come back and continue to be really successful companies.
And just to follow up on that, let's talk about what's going on in boardrooms, because as much as we're having some very difficult conversations in many boardrooms, I think we're also having really insightful, deep, meaningful conversations about leadership and what does leadership mean in this kind of crisis. I know that in our portfolio, conversations I'm having with the company, and this assumes that we're all going through the same sort of mourning process of first you do your stress test, you find the parameters that are survivable for the company, you find the leading indicators of where you are on that survivability continuum, and you move along that. We can unpack that, but I'm going to assume that that's happening. How do you guide a company through the uncertainty of what's coming? And it boils down to leadership. And among my companies, the discussions we're having sound something like this. What is the value system that we're making decisions along? For some companies, it's we want to keep as many people on our healthcare plan as we can. For some, is we want to skinny down to the tightest survivable team that we can in order to be as resilient as possible. There's a whole array of decisions that are valid value systems, but you have to decide them actively. You can't just default. If you decide them actively, then you can communicate to the team, and this is ever more important because we're all remote. You can guide your team to how the decisions are being made. The people underneath you and your team can also arrive at the same decisions by looking at the data and looking at the value system. Without that, all this uncertainty becomes really debilitating to companies. Whereas with good leadership, the uncertainty actually pulls people together as long as they know the why and the how of how decisions are being made. So start with the value system. What is it that we stand for? Why are we making the decisions that we're making? Clarify those values and the decision processes to everybody on your team. Allow the vulnerability of uncertainty. We just don't know a lot of things. And listen really, really hard. Listen to the team, listen to the customers. Companies that do that well for the most part, will have the best odds of surviving. Not every good company is going to survive in this. You know, Warren Buffett's pretty famous for saying, we only know who's naked when the tide goes out. I guess that's true, but I don't think we're dealing with the tide going out right now. We're dealing with a tsunami. And a tsunami doesn't tell us who's naked. A tsunami only tells us who survives. So I think the companies that have that leadership capability are the ones that are more likely to survive. What that says about the United States, I don't know.
Well, I certainly didn't expect that we'd be discussing nudity during tsunamis, but I don't know if other people want to react to Jody's provocative comments about leadership, nudity or tsunamis. Any takers there?
I'll take it on leadership and I'll avoid nudity.
Excellent.
Oh,
So-
Jeff, that's such a cop-out to avoid the nudity. Come on.
So I think Jody's point is great, and I'll recommend two books that I've been coming back to in the last few weeks on this theme. One is the Adam Grant, Sheryl Sandberg book, Option B, which was originally written when in sort of the retrospective healing process that Sheryl went through when she tragically lost her husband to a heart attack. And Adam talks in his research about the notion of traumatic growth, that looking for growth in trauma or post-traumatic growth. And I think there's a really interesting lesson there that many of our best leaders are finding. And then the other is Ryan Holiday's book, The Obstacle is the Way, which is another book about looking at, and this is more about the aesthetics and looking at some of the Roman Stoics lessons and looking at the writings of Seneca and others that talk about why obstacles can either stop people or other people can view obstacles as opportunities and turn obstacles into opportunities and really view them as ways to grow as leaders and grow as people. And I had a young VC who said it to me really well the other day. She said, I'm looking at this as an opportunity, this crisis, this pandemic, as a way to build my chops, because I've never been through a crisis before. And now I have this opportunity to step up and show myself as a good, in her case, leader and board member. And I think that's a great approach and attitude that I'm trying to channel as best I can through these two books and others that I'm reading.
And how how are people thinking of that? What are the attributes that you're looking for, or specific examples, not of sort of heroism, but what are things that people can do or are doing? Are there different character traits that you're prioritizing and looking for in outreach, whether it's email outreach or a Zoom call or something?
And this is, it should only become more important during COVID, but I really look for two things: resiliency and the ability to communicate well. The last point, now is not the time to send these glowing investor updates where you have no problems and everything is totally fine. It's the opportunity to be super honest about what you're dealing with and to over communicate more than under communicate, right? I want to hear, if I send you a text and ask you, how are you doing? Yes, I definitely want to hear how you personally are doing, but it's not just a casual how you're doing. I'm asking you, how much runway do you have? Are you going to run out of money? What's your burn rate? I'm asking you, all the hard stuff. And the ability to be resilient and adapt is super important for early stage companies. And I've always looked for companies that I call cockroach companies. Like, if something happens, they're just not going to die. And this is the when something happens, you have to figure out how you're not going to die and how you're going to stay alive long enough to execute on the longer term vision. And so that means doing some things that you didn't anticipate doing in the short term, and trying to shore up for the long.
Yeah, it's also about decisive and bold action. People that took action as soon as things started to go sideways versus people that sat around, they waited, and now they need X amount of money because they waited 2 months too long. versus folks that saw the writing on the wall, made, and of course, they can always kind of backtrack off of a tough, quote unquote, wrong decision. But it was going to be better to be wrong in one direction versus another direction. So those founders, they gain a certain amount of more respect. And you get to see that. You see those people who made bold decisions early, and made decisive decisions early, and that's what you're looking for, especially in a time like this.
Some of them, though,
The founders out there should also know that these are not theoretical discussions from the perspective of the VCs. We're having the exact same set of discussions, conversations, challenges in dealing with our investors, and needing to communicate how we're making our decisions, right? And some of our investors having their own challenges, whether it's the denominator on their portfolio having changed and so on. So these are kind of fractal problems. They happen at the customer side, they happen at the portfolio side, they happen at the VC level, they happen at the LP level. Getting a clear view of where everybody is in that stack is really helpful to you as you try to navigate all these uncertainties.
And we've talked a little bit now about some existential threats. There's a question that I want us to come back to about board discussions where the pandemic has put the viability of the startup in question, or of the startup concept in question. And I've been a participant in several of those conversations, but I've also gotten questions, mostly in the private chat, about PPP loans. And I wanted to make sure we got through at least the first hour of this without mentioning them. I'm glad that we did. But I'd love to talk a little bit about that. There's been a pretty significant shift in perception over time among the venture community, from some early cheerleading toward them to some more skepticism, and now what I'll actually call revisionist history, where VCs who were pushing portfolio companies to, quote, take the free money, are now saying, well, we've been conservative on these from the outset, and we don't think that anyone in our portfolio should take them. And, I've watched people across boardrooms where that's just not true. They may say that in late April or early May, but it's not the case. And I want to go into a little bit of the specifics, and if people do have questions, you're welcome to hit me with them in the private chat. But I'd love to hear from some of the venture investors how you're viewing this and how you're viewing market reaction, not just today, but 6 months or a year from now. And to frame it, last night there was an extension of the reconsideration period from ending on May 7th to ending on May 14th. It's a limited safe harbor period. Unfortunately, when they released that, the Treasury Department, or the SBA, said, by the way, we're going to give more guidance on how we think about the certification of need. And that scared a number of us, because what we don't want is on May 10th for them to come out with some new standard saying, and by the way, when you certified need, what you really meant was you were down more than 20%. And then we're all scratching our heads and convening new emergency board meetings. So, I think the Treasury Department has done a really terrible job of telling people we're here to help. People who often don't like to ask for help then asked for help, and then Treasury said, we'd like to make you all feel bad about having asked for help because we didn't give you enough guidance. But how are VCs thinking about the difference between companies that took and companies that didn't take, and companies giving back? What's the conversation? Don't make me call on you. Well,
it's definitely been a moving target, right? As the CARES Act was coming together, it was very unclear what it would include, what guidelines would be associated with it. And I describe the mood of CEOs leading up to the CARES Act as them thinking it was their responsibility as this good CEO to be figuring out how to apply. In the past few weeks, there has been a change in attitudes as CEOs are realizing that both the written law and in some ways the spirit of the law is that it might not apply to every venture-backed company. So we have had companies in our portfolio who have pulled applications. We have had, do we have any that have actually returned the capital? I think they all pulled the applications before they got the capital. Okay, maybe there's one you might know in more detail. But overall, the conversation that I have with founders who are still thinking it through is to talk through the like sunshine test. First, it's like, it's very clear if your industry has been positively or negatively impacted by COVID. And in some cases, if your business is doing better than ever, like, hell no, don't touch this. There are also other cases, like I work with a founder who did lay off her whole staff and her business is down 90%, but she still chose not to put in an application because she has over $10 million in the bank. And so she's thinking about liquidity concerns, which is not written in the letter of the law, but she felt that, you know, if there already are being, you know, Wall Street Journal articles written about this, do you want to be on the cover of the newspaper with a screenshot of your bank account and side by side with a mom and pop small business on Main Street that had to shut down that didn't receive the loan? So in many ways, it's turning into more of an ethical question for some founders, and they're choosing to say no because of that.
Anyone else want to share a view, Jody?
Sure. The PPP, we've been talking in many forums about PPP and its tactics and its analysis and its shit show of the guidelines and whatever the hell an interim final whatever is. How you could be interim and final is a whole different thing. Strategically, the thing we need to understand about PPP is that it's a failure. It was based on faulty assumptions. The assumptions that underlie PPP are that if we can just keep people in their jobs until June 30th, our country will be on the other side of this and we can get back to our regularly scheduled election programming. And we didn't, maybe that was an okay view in February and early March when they were evaluating this, but we didn't do the things as a country. Again, it comes back to leadership. We didn't do the things that needed to be done in order for that to be anything close to a reality. Now, why does this matter from a venture perspective? The failure of PPP, which will be, you know, PPP was legislated in haste, but it's going to be litigated at leisure. And the retrospective analysis of it as a failure is going to come in and sweep up many people who have participated in it. So each company's got to do its own analysis of where do we want to fall within that. I think there are companies, including venture-backed companies, for which it's very legitimate. But understand that the whole program is going to be called a failure in the future. And many people are going to be called to task that were otherwise just trying to do the right thing.
For sure.
Very pragmatic approach to advising my companies around PPP. One, I invest in a lot of companies led by women and underrepresented founders. I think I recently hit 50% of my investments have been in women-led companies, right? And so if those companies, one, did not have a lot of investors who could top up on their last round price, or if they did not have a lot of cash sitting in the bank, apply for PPP, right? You're often the last to get invested in anyway, right? And so, you know, just sort of reading the tea leaves, you're going to need a little bit of cushion in order to stay alive and to remain in business. And, you know, a lot of that money is very necessary for companies led by underrepresented founders to survive. And so, you know, if you're able to get it, you should absolutely take it.
And not to go too deep on this, although I'm happy to talk more about this later. We believe that there's a hierarchy that you have to go through, and the first is eligibility and affiliation, and that requires true legal analysis. We also have seen a lot of shoulder shrugs by counsel. We've seen italicized disclaimers on emails saying that PPP loans are an unprecedented thing and you can't really hold us to the legal advice that we're giving on it. I think that's utter bullshit. I think that we are supposed to put our asses on the line, and there's a difference between writing a formal legal opinion letter and walking into a boardroom and saying, we've looked at the documents. If there's stuff you haven't shown us, we haven't seen it. We've looked at the documents, we've discussed it, we've raised these issues, we've done this process. We don't find affiliation with your venture fund as a result of this. And because of that, we are telling you that there appears to be eligibility. It's imperfect. It could later be wrong, but we're telling you in good faith, we've done the work. You're paying us maybe to do the work, and our ass is now on the line, and you are clear from that perspective. That's step one. Step two, you have to have good process. You have to have governance. You have to actually talk to your board before you apply and show them in writing what the hell is going on and why there's adverse impact, why that impact is meaningful, why you can't raise other money on reasonable to the business terms, and that you've got stuff documented, you've made legit calculations. And so for that phase, part of that is legal analysis, part of it is business analysis. And then the third part is making the decision about whether you need the money, and that requires a board conversation with authorization. And if there are 20% stockholders, you have to disclose that. That's different than affiliation. And I think it's our job as counsel to walk into that boardroom and say, you're in the zone, and you can make a decision as long as you have shown up to board meetings and have read the material, have asked questions, and discharged your fiduciary duty, whether you vote yes or no. You're going to be in the zone of what a reasonable board member would do, and therefore you deserve some deference and protection. We're not, as lawyers, we're not supposed to make the need determination with you, but I've walked into plenty of boardrooms in the last 2 weeks and said, I don't see how you're in the zone. Why are you saying you're in the zone? You have 12 months of cash in the bank, and I know that your feeling is that you're going to lay people off if you don't get this money, but that's your discretion. That is not existential threat in the next 3, 4, 5, whatever months. A year of cash is not what this, show me the restaurant, show me the hair salon that has a year of rent, utilities, and payroll in the bank. They don't. And neither should you if you're taking this money. If you are going to go out of business in 3 months or 5 months without this, take the money, have the conversation, and we will tell you you're in the zone for business judgment rule. But one thing that's been frustrating as hell from where I sit as a lawyer is, as clients are, whether they're going to pay us or go out of business, they are our clients, and we need to give them actual legal advice that gives them cover to rely in good faith and then take reasonable steps. So if you're getting a lot of shoulder shrugs, we're seeing a lot of shoulder shrugs, and you shouldn't be. Certainly anyone who's getting shoulder shrugs from our firm, from Lowenstein Sandler, reach out to me and I will make sure that we explain what's going on and that we figure out so that we can get you to not a shoulder shrug. It's an enormously stressful time. We don't want to add to that stress.
Were you suggesting getting the written legal opinion from your counsel?
No, I'm saying that I'm seeing in very rare instances, I'm seeing someone ask for a formal written legal opinion of eligibility. But no, generally speaking, what I think should happen is you do the review, you do an email that explains what was done and the questions raised. If someone needs to do a waiver or an amendment before the loan, that's not a problem. If someone needs to do a waiver or an amendment after the loan is applied for, or even worse, after the loan has been dispersed, that is a problem. And there should be a discussion and there should be disclosure to the bank at the very least. But I have other thoughts on that as well. But I think that if you're in a boardroom and a board member asks, does this company have an affiliation problem such that it is ineligible before we even consider need, it is very hard for a lawyer to defend a shoulder shrug at that point because the lawyer should be doing the work and asking the questions. We definitely have seen situations where we are company counsel or investor counsel where someone has not been given the opportunity to do the work. That's different. And you got to speak up and say, we weren't called upon to do the review, or we first did the review after they applied because that's when they asked us for it. That's okay. Let's have that discussion. But people, prudent business people, need to have the cover of having, in good faith, evaluated whether they're eligible. Frankly, I think it sucks that a law that's designed to help people in the most stressful period in recent American history requires this much lawyer. It shouldn't. That's not the point. But this is a time when lawyers should be there for their clients and should answer those questions. And yeah, if people want an email saying, if you looked at affiliation, like, we need to give them that email so that they can make an informed decision as a board member and say, we did this. Because everyone over 2 million every loan over 2 million is going to be reviewed. SBA will make loan specific disclosure. The Freedom of Information requests have like quadrupled in the last couple of weeks. There will be enforcement activity, and loans, I think loans over $500,000, loans over $1 million, they are going to be investigated, and there will be litigation, and there will be whistleblowing. So an email disclaimer, for instance, that says this is an unprecedented period of uncertainty and our legal advice is not something that you're going to hold us accountable for, like, I think that's bullshit. I think we are going to be held accountable for our legal advice. Am I thrilled about the position the government has put everyone else in and lawyers? No, but we have to do the best we can and say, this is our guidance and you've got some coverage because of it. You have to. Otherwise, what the hell are we doing here? So moving along, unless there are other questions on PPP loans and the role of actual legal advisor in the context of PPP loans.
I have one quick question on that, if I can. Do you think that companies that have done what I would call unnatural acts, but have changed their protective provisions, something that had to be filed in a charter in order to qualify for these loans, will they be subject to additional scrutiny?
So, yeah, I've had these conversations with my colleagues who are prosecutors and former attorneys general. Again, if you think about process, if you do stuff in advance, then I think that you're going to see people who took steps and had a deliberative process and acted in ways to protect the business. If you have waived a protective provision that entitled a venture investor to object anytime you wanted to borrow money or declare a dividend, as an example, because those are things in the SBA cases that would make that venture investor your quote unquote affiliate, that could be a problem. I think that's, we're going to see a lot of companies having done that. And hopefully SBA should say, we get it. Where you have a venture investor or private equity firm that has a 50% ownership stake or half the board, I think those companies are going to come in for a tremendous amount of scrutiny. I think that's not what the act was designed to protect. And I think that investors where they've made charter amendments after the loan has been dispersed and they haven't disclosed that to the bank, my prosecutors told me that they may not know a lot about corporate action, but they do. But prosecutors love finding shit that looks like it was hidden from them, and that's what that's going to look like. And so that is cause for concern. And although the reconsideration period or the limited safe harbor period is designed to protect you on the certification of need, that's the kind of loan that you may want to return and figure out what the hell you're going to do, because it would be nice to not have to deal with that, because going forward you're going to be making representations and warranties about that in in deals to come for years. So it's not a blanket statement, but if you did it beforehand and you have minority investors who maybe are tapped out and you're good on need, I think it's okay. If you did it after the fact, it's, that's less cool. Um, back to how we're going to get money into companies. You talked about sort of being honest and saying, there's bad news going on. That's fine if you're an existing portfolio company. What do you do if you're in sell mode? What do you do if it's your second Zoom or phone call with Kirby and he asks, tell me what's going on in the business, and you also want to have Kirby make an intro to Jody for next round funding for your A round ready SaaS company, and Jody's going to do 3 A rounds herself this year, only 3. So how much bad news do I lay on Kirby?
I think you lay on all of it. But if you're looking for some good news as well, I mean, so being honest with the bad news, and also there needs to be some good news in the business if you're looking for another round of capital and not just a top up, or hey, we're looking for some money to get through this down period. So some people are just looking for money to get through this down period and taking this downtime to retool and improve operations or improve things while there's just may not be a lot of business going on at this point. So you have time to fix things that may have been broken because you were growing so fast and moving so quickly prior to the shutdown. But give all the bad news now and have made all the tough decisions early and done a bunch of right things in a bad situation. But hopefully there's some good things going on.
I want to challenge you a bit on. I know it's the second time you've said made those bold moves early. We're talking about leadership in a period of unprecedented anxiety and suffering and frankly death. And people made bold moves. Some of them were the right move. Some of them were the wrong move. And sometimes with the wrong move, it's really hard to unscramble the eggs. Mm-hmm. And there are consequences to that. So not every bold move was a good idea. Some of them were really, really bad ideas. And there's a spectrum. How do you deal with people who are walking it back? How do you deal with people who wanted more data before making that decision? And it shouldn't be, the fact that during the first 3 weeks of the pandemic or the first 5 weeks of quarantine, you didn't act fast enough. That shouldn't be a complete strikeout for that group of founders or for that board. So what are you advising there? How are you thinking about those folks?
Well, there's some analysis in when you're making a decision, and if you want to make a decision with some clear analysis and some clear thought process that you can communicate to stakeholders. If you've made a decision and here's why I made the decision, and they're able to express that in real time, and it was a wrong decision, and it took input from the people around the table, the other stakeholders, investors, and look, I listened to everybody's input, or I listened to input. I saw what the environment was, and here's kind of how I came up with my decision. If it's sound, you can move past it. And if the flaws that were in the decision making, you decide if that's inherent in the founder, or is that something that was this is just a weird thing to happen. This is an unprecedented thing to happen. So, there are flawed processes or flawed people, or and then this is just a wholly unique circumstance that we're in. So, so as an investor, you got to figure that out.
What guidance do you have for people as they, I know we've got about less than 10 minutes left. What are some things, some specific tactical things or strategic things that people can do to pave the way for a fundraise, to um, make sure that they're like doing, the best leadership stuff they can do to get through this period?
So I'll throw out one tactical thing. We've been telling our development stage companies that this is a spectacular time to spend time with customers. Customers are more willing to give you time. Prospective customers, as part of your customer discovery process, are more willing to give you time now than they ever were. And, Kirby made the point, fix some of the things or attend to some of the things that maybe you were moving so fast you didn't attend to. Really going deep on customer discovery, really understanding where your customers are at, making sure that you're discovering some needs that they may have or surfacing some issues that they may have that you may not have thought through, improving your product, taking the time to deal with tech debt or operational debt or organizational debt. You do those things and you emerge from this period after 6 or 12 months, and you're going to be really well positioned. And speaking about that with investors, I think will impress people, because it shows that you've, again, looked at this as an opportunity, not just as a traumatic situation, but one that you can grow from and benefit from.
I would totally second that. We're really seeing companies get quality time, really great feedback from customers. In some cases, they're taking a secondary value proposition, and it turns out that now it's the primary one that customers needed. And they were moving so fast, I don't know they would have heard that. That signal would not have risen above the noise in the environment we were in before. But now there's all kinds of rich data to gather if you're willing. And I know as an investor, the data that I value the most in my investments is that from the customer. That I like quantitative data from customers. Why did you buy? What did you measure it on? The companies that spend time doing that now will be really well positioned going forward.
Spend time with customers. What about getting on your radars, particularly now that folks have been told don't raise money if you don't have to? And now that we know that while Haley is spending a lot of time on parenting stuff, she also has only half the deal flow. And by the way, let me commend you also for saying you have half the deal flow, because I think everyone knows what a great brand First Round is. So it's not like you have half the deal flow because but there has been
I
this
think it's
really
the market, not us. I hope.
no, but that's why it's important for you to speak out and say that, because there's been this Bay Area thing in particular about, and I know you're not Bay Area, but the fund is in part Bay Area, about, we're killing it, everything is great, everything is up and to the right. Life does not work that way. And we've certainly seen that with the company like Airbnb doing a big layoff yesterday, which is unfortunate. And it's important to hear that deal flow is off by 50% at, a super high profile, great seed fund, because that's an important barometer of the market. And there is so much that's opaque in this market. So what do we do to get Mindshare to get on your radar? And, Jeff, I'm sure that you've got all these students you've been teaching at HBS, presumably students who couldn't get into Columbia Business School, who reach out to you and say, I took your class 7 years ago and I want some career guidance. Like, there's a lot of competition for your time. How do we get, this is my final question, how do we get on your radars now as compared to pre-pandemic, pre-quarantine?
You want to go first?
Yeah, sure. I'm getting a few inbounds from founders who are saying that, they're not actively raising, but they're using this time to build relationships with potential investors. And I mean, that was always a line that founders could use, but I think it could be particularly effective right now. And the important thing to do when you have that phone call or the Zoom call is to lay the groundwork of really sharing how you're going to approach the next few months. Start giving investors the data points of what your leadership style is and what your plan is, such that when you do go back, even if it is just 4 to 6 weeks from that first conversation, the investor can plot a line between the two data points and understand how you navigated. Did you do what you said you were going to do? And how tightly you have your hands on the wheel during a really dynamic market.
I'll just make a tactical suggestion. It used to be when we met face to face, it was a higher bar, both because a face to face meeting is a greater time commitment, but also a greater emotional commitment. You're not going to just meet for 15 minutes face to face. You're not going to drag somebody across town to come up into your building and meet with you for 15 or 20 minutes. You're going to give them a full 45 minutes or an hour and be more flexible. But now I think, founders can ask for smaller time slices, 15 minutes, 20 minutes, certainly 30 minutes max, to do exactly what Haley said, which is just, let me tell you what I'm up to. Let me give you an update. I'm not raising money now, but I just want to, start opening up the communication channel, make sure you are aware of what I'm doing, and just be really cognizant of the fact that you can jump in and take these smaller time slices, and nobody needs to feel bad about that.
Don't do and a quick do. Don't do. Some things have changed since before the pre-virus time. When I get those emails that are clearly a big, huge blast to a whole lot of people, maybe that was going to inspire a lot of FOMO investors to jump on. Those are going to be completely ineffective right now. Don't do them. Don't do the big blast. Don't do anything that has an unsubscribe button. Just don't do that. On the other hand, I think a targeted approach will be even more effective now than it was before. So in other words, Ed mentioned earlier, there are certain investors that do one kind of thing, certain investors that do another kind of thing. Don't confuse them. Do your work. You're the one asking for a check, right? So check out your market, check out what it is that you're asking for, and find the ones that are aligned with that approach. I always respond to cold emails if they've done their work, if they've looked at what we invest in or at my writings or something that shows that they know why I would be interested in them, and then speak to that. When I get cold emails that don't include that, it's not that I don't respond, but it doesn't feel respectful to me. It's like you want me to look at your stuff, but you haven't really looked at mine before asking me for money. So you can still do cold emails as long as they are targeted and thoughtful, or else do the work of finding an intro. Those things still work. You'll still get attention.
And I realize that Monique, did you want to add something to that?
I was going to, and then they started doing something outside my apartment. I was just going to add, meet investors where they are. We're on this panel, we're doing other panels. So being able to create relationships like that, either on Twitter or on panels, is hugely important.
Great. I want to thank everyone for joining. I particularly appreciate Monique, Jeff, Jody, Haley, Kirby for being part of this. If there are ways that we can help give guidance, great. I do love the idea of reaching out after you know something about the investors rather than a blanket the universe approach. And I do also think it's important to find ways to make sure that we are transcending networks so that we're not continuing to embed structural bias, because this is a time where structural bias is really felt in particular. So thank you for making yourselves available. Thanks for joining, and hopefully we'll keep in touch. Take care, everyone. Be safe.
And thank you to the whole Lowenstein team. You've been really, really proactive in all of this.
Thanks, Ed.
Exceptional.
Kind of.
Thanks, everybody.
Good seeing you all.